Good evening, and welcome to the Crypto Overnighter. I'm Nicodemus, and I will be your host as we take a look at the latest cryptocurrency news and analysis. So sit back, relax, and let's get started. And remember, none of this is financial advice. And it's 10 p.m. on a Saturday, June 3rd, 2023. And welcome back to the Crypto Overnighter, where we have no sponsors, no hidden agendas, and no BS. But we do have the news, so let's get to it. There's a new draft bill introduced by senior Republicans in the U.S. House. This bill aims to provide a clear path for digital tokens to transition from being treated as securities to commodities. It was released by the House Financial Services Committee Chair Patrick McHenry and House Agriculture Committee Chair Glenn Thompson. This bill seeks to establish brighter guidelines and more flexibility for digital assets in the U.S. One of the bill's key provisions is to define the criteria by which a project is considered sufficiently decentralized. That would determine whether the tokens qualify as investment contracts or not. This draft bill is intended to initiate negotiations with House Democrats and their Senate counterparts. The goal is to pass a law this year governing the market structure of digital assets. The reception from other policymakers and the Biden administration will be crucial in determining the future prospects of this legislation. U.S. financial regulators, led by Treasury Secretary Janet Yellen, have called for new laws regarding digital assets. Committee staff have been in contact with several senators to pave the way for passage in the Senate as well. The bill aims to create a more stable and investor-friendly market structure for digital assets. It also addresses concerns that existing security laws may be too rigid. It introduces a definition of a decentralized network that would allow tokens to transition from securities to commodities with lower disclosure requirements. Now, here are some of the conditions as laid out by the bill. The absence of control by any individual or organization for at least a year, limited ownership of tokens by issuers or decentralized organizations, and restrictions on marketing and issuance before certification as a decentralized network. Tokens issued within 12 months would need to be sold to end users. Private sales for capital raises would still be permitted, following the framework for private securities offerings. The SEC and the CFTC would determine the qualification of which projects are considered decentralized. The SEC would have the power to revoke the decentralized classification if a project becomes sufficiently decentralized. If this new bill becomes law, trading platforms for most tokens would have a streamlined process to register as alternative trading systems with the SEC. Payment stablecoins would be exempted from this securities designation, and separate legislation has been drafted to establish a comprehensive framework for this class of digital assets. The draft bill aims to provide regulatory clarity and to establish a functional framework for crypto firms in the U.S. It prohibits the SEC from denying digital asset trading platforms from registering as regulated alternative trading systems. It allows those platforms to offer digital commodities and payment stablecoins. The legislation addresses criticisms of the SEC for its lack of clear rules. It also requires a detailed analysis of objections to the classifications of firms as decentralized. The bill also requires the SEC to modify its rules to allow broker-dealers to custody digital assets and to modernize certain regulations for digital assets. While introduced by Republicans, the legislation lacks input from Democratic lawmakers, and its progress in a divided Congress remains uncertain. From the halls of Congress, we move to the courtroom, where the crypto world is taking a stand. The Blockchain Association filed an amicus brief in a lawsuit against the U.S. Treasury Department and the Office of Foreign Asset Control. This suit was brought by the think tank Coin Center. Coin Center alleges the Treasury Department's sanctions on crypto mixer Tornado Cash have harmed Americans. Specifically, Americans' ability to transact privately on the Ethereum network. The Blockchain Association CEO is Kristen Smith, and she said punishing Tornado Cash as a tool contradicts the values this country was founded upon. Regulatory actions should target bad actors who misuse the tool for illegal purposes. Which makes nothing but sense to me. Responsible governance says that you allow people their freedoms and address the problem actors as they make themselves known. And they will make themselves known. But just because there are problem actors doesn't mean everyone's rights should be curtailed. Be an adult. Deal with the actual problems. Don't just blanket punish everybody because it makes governing easier. That's tyranny. Maybe that's just my opinion. Anyway, this is the second lawsuit filed by the advocacy group against the Treasury Department regarding Tornado Cash. OFAC sanctioned Tornado Cash back in August. They claimed that North Korean hackers had laundered millions of dollars worth of crypto through that mixer. The crypto industry opposed the move, arguing that OFAC typically does not sanction software and that Tornado Cash does not have a central operator. The lawsuit emphasizes that there are legitimate uses for privacy-enhancing tools like Tornado Cash. They also object because the sanctions expose an individual's entire transaction history on the network. The Blockchain Association, along with the DeFi Education Fund, filed an amicus brief supporting CoinCenter's case. They described the Treasury Department's decision to sanction Tornado Cash as unprecedented and unlawful. Coinbase is also backing another case against the department over those sanctions. Both lawsuits allege that the government exceeded its authority by targeting software instead of individuals or entities. The lawsuits seek relief to allow legitimate activities with anonymity, to allow the use of their preferred software without penalties, and finally, to protect the important sector of the economy that relies on Ethereum. Now, while the legal battles continue, the crypto world is also making strides in the entertainment industry. Let's take a look. Binance announced the winner of its Web3 reality show called Build the Block. The show featured startups competing for investment from Binance Labs within the metaverse. The winner of the contest is zkPass. That's a decentralized identity verification solution that focuses on privacy preservation. The startup utilizes multi-party computation and zero-knowledge proof technology. Joshua Peng is a co-founder at zkPass. He expressed his excitement about winning the competition, especially the opportunity to collaborate closely with Binance Labs. The investment received will support zkPass in building a decentralized infrastructure. Yibo Ling is Binance's chief business officer and one of the judges in the contest. They expressed Binance's anticipation for the growth of the winning startup. Binance aims to establish sustainable ecosystems that promote scalability, particularly through the utilization of zero-knowledge proof techniques. Apart from zkPass, 4 other contestants received investment offers from Binance. These include Mine Network, that's a decentralized, privacy-preserving data lake. CryptoScout is a platform that simplifies Web3 finance. Bracket Labs is a DeFi platform creator, and DAppOS is an operating protocol. In other news, the blockchain protocol Anoma secured $25 million in funding for the continued development of its architecture. The Swiss nonprofit aims to build a generalized, intent-centric blockchain architecture. Adrian Brink is one of the founders, and he said the platform's third-generation architecture offers improved composability and ease of use compared to existing smart contract protocols. From the virtual reality of the metaverse, we now turn to the physical reality of crypto ATMs around the world. In a surprising turn of events, the number of Bitcoin and crypto ATMs worldwide saw a significant increase in May after a year-long decline. And we've talked before about the number of Bitcoin ATMs and crypto ATMs, they're both going down. Well, that seems to have changed. A total of nearly 1,400 net installations were recorded during the month of May. Now, as I said, during the first quarter 2023, the total number of crypto ATMs had consistently decreased. This decline was primarily driven by major economies like the United States. However, we also covered the fact that some countries like Australia, Poland, and Spain bucked that trend and increased the number of ATMs they have installed. CoinATM Radar data confirmed the global crypto ATM network experienced a decline of 5,850 machines in the first 4 months of this year. But in May, 1,397 new machines were added, signaling a reversal in the downward trend. Bitcoin ATMs serve as physical gateways for individuals to exchange their fiat currencies for cryptocurrencies. While they don't directly contribute to the growth of the Bitcoin network, they play a crucial role in enabling crypto adoption. Now, I personally also see them as a really good temperature gauge for street-level retail demand. Demand goes down, machines go away. Demand comes back, so do the machines. Australia emerged as a significant player, installing a total of 233 ATMs in 2023 alone. This achievement propelled Australia to become the world's third largest crypto ATM hub. Despite the overall decline, the United States still maintains its leading position, representing 84.7% of crypto ATMs worldwide, followed by Canada at 7.6%. Currently, there are 35,069 operational ATMs globally. However, a recent incident raised concerns about the security of Bitcoin ATMs, because a hacker was able to gain unauthorized access to sensitive information of Bitcoin ATM manufacturer General Bytes. This information did include passwords, private keys, and funds. General Bytes promptly responded to the security breach, taking immediate measures to prevent further unauthorized access and to protect its customers. The company is working diligently to enhance security measures. The hacker managed to drain at least 56 Bitcoin and 21.82 Ether from the compromised system. To prevent similar incidents in the future, General Bytes advocates its operators and customers migrate to a self-hosted option. Such an installation can be secured with a virtual private network. I've secured many a server with a VPN. It's not hard. Now, while crypto ATMs are on the rise globally, let's shift our focus to Africa, where the Central Bank of Kenya is making some interesting moves. The Central Bank of Kenya stated that addressing the challenges in the country's payment system can be achieved through innovative solutions within the existing ecosystem. They suggest that a central bank digital currency may not be a top priority. The bank received over 100 comments during a consultation period that began in February. Respondents represented 9 countries. That includes representatives from commercial banks and institutions. The feedback highlighted the benefits of a CDBC, such as increased efficiency, as well as concerns regarding high implementation costs and potential financial exclusion. The central bank noted that countries that have issued CDBCs faced implementation challenges, and recent instability in the cryptocurrency market has amplified these concerns. Now, we've spoken about Nigeria a number of times, specifically because they have experienced adoption issues with their central bank digital currency. Meanwhile, the Central Bank of the Bahamas is working on improving its CDBC adoption. Still, 3 years after its launch. The Central Bank of Kenya said that it will continue to monitor CDBC developments. They said that they will make future assessments, acknowledging that the allure of CDBCs is diminishing. Despite Kenya's growing adoption of crypto and blockchain, the central bank believes that other innovative solutions within the ecosystem can continue to address the country's payment challenges. Go Kenya! As we see the global landscape of crypto and digital currencies evolving, let's turn our attention back to the US, where Elon Musk continues to face controversy, this time in the courtroom. And obviously, this is our cover story for the night. The Manhattan Federal Court in New York has received a third complaint in a proposed class action lawsuit against Elon Musk. This complaint was initially filed almost a year ago, on June 16, 2022. The complaint accuses Musk of insider trading and includes various activities under one legal claim. Now, if you remember, Elon Musk appeared on Saturday Night Live in May of 2021. So they're saying that that was a publicity stunt to manipulate the price of Dogecoin. The complaint also claims that Musk paid social media influencers to achieve the same goal through their posts. It's alleged that these actions by Musk drove up the price of Dogecoin, allowing him to profit from his own wallets or those controlled by Tesla. Musk's legal team is led by Alex Spiro, and they filed a motion to dismiss the second amended complaint on March 31st, 2023. They argue that that lawsuit was a fanciful work of fiction and lacked a clear explanation of the alleged fraud. Musk's lawyers said that tweeting words of support or funny pictures about a legitimate cryptocurrency with a market cap of nearly $10 billion is not unlawful, does not represent market manipulation. The presiding judge is Alvin Hallerstein, and he indicated that the third complaint is likely to stand, as the defendants do not appear to be prejudiced. This may be referring to one of the newly added defendants, Jackson Palmer. Palmer is one of the co-creators of Dogecoin, and he has previously referred to Musk as a grifter. In April 2023, after Musk acquired Twitter, he changed the platform's logo to the iconic Shiba Inu image associated with Dogecoin. Following this change, Dogecoin's market cap increased by approximately $4 billion. The third amended complaint alleges that Musk sold around $124 million worth of Dogecoin after that price boost. Musk presented the sale as a promise fulfilled to a popular Twitter user. The class action lawsuit suggests that Musk keeps track of his tweets and could use them as justification for his actions. Dogecoin itself is an inflationary coin without a maximum supply. They allege that this makes it a poor store of value. Its value relies heavily on sporadic media boosts and is prone to wild price swings. Many people who bought Dogecoin at its peak experienced significant losses. The Dogecoin rich list reveals that token allocation is highly concentrated. 144 addresses hold 70% of the existing circulation. It's speculated that Elon Musk may hold one of those addresses, but that is pure speculation. The lawsuit may be an attempt to address the influence of whales in centralized markets. That would make Musk a most visible target. As the second richest person, according to Forbes, Musk is a prominent figure in the cryptocurrency world. And that's going to do it for us tonight. And I want to thank you so much for listening, because when you stop listening, I'll stop talking. If you enjoyed tonight's show, then please like, follow, subscribe, leave a rating, or maybe a review. And in the meantime, we'll see you tomorrow night.